Hello, founders. We are live. Welcome to Startups.com. Got a great show for you every Tuesday, Wednesday, Thursday, same time. But in this one, we are going to be talking about your burning questions that we're sourcing all over the place across the interwebs that founders want to know. And I got Will here. Will, he is the CEO and founder of Startups.com, 9-time founder, 5 exits. We got so
As
far.
of exactly this time last year. I mean, almost like to the day, last month.
I remember you going through that last exit, and that was quite the lift. So
yeah,
it's great
that went well.
Great to have you, Will. For everybody else, we've got Q&A today, so you want to use the Q&A box or chat to ask questions. You can interrupt us. We're happy to stop everything and answer your questions, or we're just going to work through our questions that we have, and that's going to be something that we've been gathering we're going to do on a regular basis. And before we even get to that, thanks for everyone joining us. This show is brought to you by us, Startups.com. Great URL, by the way. If you haven't checked us out, if you're watching this on the interwebs, YouTube, do the social media thing, like, comment, subscribe. It really helps us out. But Startups.com, we have so many resources, and you can watch all our other videos. And these questions right at the beginning, just what you want to know, what you want to ask, we want to answer them for you, and then you can get an idea of what it's like to be a part of the startups community. Will, what's your invitation for everyone who's thinking about checking us out?
Well, first off, I got to point out that whenever I see our thumbnails or like our videos, whatever, I'm wearing the same outfit every single time. I have one look. I'm fully Zoolander here. I have exactly one look, and it just cracks me up between you and I and our black t-shirts. It's amazing. But here's what I would say: whatever you're stuck with right now, like whatever problem you're stuck, I don't care. It's fundraising, trying to find your first customers, you name it. We've answered this question like 1,000 times, right? Like, whatever you're dealing with, let us help you. That's all I ask is please let us help you. Come on, ask, bring every question you possibly have and ask all of them. Do not go this alone. Just not worth it.
That is fantastic. I don't know if it's both of us, but I wear the same thing. I literally have 10 black t-shirts because I do not want to make that decision any day. Is that what you do?
Yesterday I was out and I had a meeting around lunchtime, and I put on jeans and a hoodie, and I walked out. My wife stopped me. She was like, "Why are you dressed up?" So, God, this is where my life is gone. If I'm not wearing sweatpants and a black t-shirt, she's wondering what's going on. Yeah, so
that is fantastic. Yeah, it's one of those hacks that founders often do. Once again, I see all of you joining us in the audience. Thank you so much. Jen is in the background, scanning the audience, scanning your questions. She's going to make sure that we answer everything. Use the Q&A box or chat to ask questions. Will, let's jump into it. You ready to go?
Yeah, let's go for it.
First question: am I qualified to raise VC? How do I know?
Hey, Ed, let me ask you this. You've been on the VC side. What percentage of people would you have said were qualified to talk to you as a GP at a firm?
If we're talking about the overall population of founders, we're talking every founder, less than 10% all the time.
And what criteria would you have used? Like, what filter makes you go, God, they should not even be asking? Like, what does that look like?
It has to do with the notion of the difference between, this is the first level, difference between a startup and a small business. And quite often, a lot of founders think they need to be raising money, and sure, they might need capital, and that makes a lot of sense, right? But to go to a startup investor, if you came to me and I've got a startup fund and our investment thesis is startups, you're just not doing anything innovative, game-changing, hyper-growth, technology-driven, and that's usually right away where the sorting starts, is that you need to go to a bank or you need to go get other sort of mainstream investors. Startup, venture capital, we are a subset of an alternative asset class, right? That comes from like sort of the private equity tree, but we are bonkers in the VC world. So immediately that's the conversation that starts.
I remember distinctly how unqualified I was to raise capital with here's the best part, with what might have been the best business I have ever started. Okay, so just I'll take you to a little time machine. Yeah. So I'm going to go back to the early 90s, mid 90s, right? And I had started one of the first web design companies. It's hard to even think that now. One of the first web design companies. And I got an introduction to a venture capital firm, right? When I didn't even know what venture capital was. I'd never heard the term before in my life. It was kind of all in the media at the time, Ed, like in the 90s, because like, Netscape was a thing and whatever. So I take the meeting and I'm sitting in the meeting. I don't even know what to present, right? So when you're talking about, am I qualified? Number one, I'm like 19 years old. Right. Number two, the internet kind of didn't exist yet, not in the way we know it. So you couldn't find out information about like, what is a VC? Like Wikipedia hadn't been invented yet. Google hadn't been invented yet. Right. I'm 19 years old and I go into this meeting and I'll never forget the managing partner of the firm. He asks me, he's like, do you have projections? Do you have pro forma financials? And I'd never heard that word before in my life. And he could tell I had never heard it before in my life. Back to being qualified. And he goes to me and he's like, it means like you're how much money you think your company will generate in your expenses. Like, oh, absolutely. And get this. I reach into my pocket because that's where you're expected to keep your company financials, right? I reach into my pocket, I pull out a slip of paper and I unfold it, right? Because this is how pro I am. And I hand it over to him like, boom, there it is. And he looks at it and I'll never forget the look on his face. He's like, this is how much you owe your roommate. And like the fact that you have $400 in your bank account. I'm like, wasn't that the question you asked? He's like, no, okay, that's not the best part of the story. So needless to say, they pass. I mean, it's a hard pass, right? Now, here's the funny how life works. Their offices just happen to be what would wind up being across the street from our future offices at same company. Company goes on to grow to a $700 million company in 4 years, right? We win a $250 million contract like a year later, and we end up staffing to like 1,000 people right across the street from them. Okay, like in the same parking lot. We shared a parking lot. And so they would see this idiot pulling up in a brand new Lamborghini, right? The same idiot who was like, I don't understand what a pro forma is or, whatever. And I ended up in the strangest like twist of fate. I ended up meeting the son of the owner of that firm in Santa Monica of all places, right? Great guy. And he started his own firm and he would tell that story. He's like, you're like a legend at that firm, right? Of being the most unqualified investment that we ever miss. And he was like, nothing about that was investable.
Those stories are amazing. I'm curious, Will, did you end up raising money for that venture? What happened?
We didn't. We bootstrapped the whole thing. We grew it to about 700 million in billings, which isn't all revenue. And we sold it to Dan Snyder, the owner of was the owner of the Washington Commanders, who had an incredible career, obviously, outside of that.
I had no idea that was a story. Now, you're even more legendary in my mind. But let's talk about this for a moment, because I think a lot of founders, like you and I, we've been through so many different cycles of this, like so many bubbles right from the get-go, like when the internet just became a thing. Things have changed. So back then, investors were looking for different qualifications. I would say it was more like bankers, and they needed all that due diligence, and they wanted things like business plans and pro formas. Today, VCs, like I actually sat on a due diligence meeting today, an investor trying to raise capital. We didn't ask any of that stuff, right? We were asking a whole bunch of different things. How has it changed in terms of the qualifications or the way VC's done today?
I think what's changed so dramatically is that so many companies have come from just idea or just MVP or just this formative Facebook early kind of stage to go on and become billion-dollar companies, that investors have no longer believed that they can diligence their way into good deals, right?
Yes.
In other words, there's so little trending data to go on, and you're playing with a founder, with your money, who's probably never started a business before. This isn't like the old school silver-haired fox that people were invested in, right? This is a 24-year-old in a hoodie.
Yeah.
And you have no idea. Like, this person has no, resume or past experience. And so that story has played out so terrifically so many times that at some point investors look at the trend line and they're like, honestly, other than the idea's got a big market, I'm not going to be able to diligence my way into knowing this is a good investment or not. What do you think? Exactly.
We have gotten good as an industry, and I'm not even really in that industry anymore, but I know how it works. We've gotten good at pattern recognition. It's like, do they look like a tech bro wearing a hoodie and they haven't gotten a lot of sun and they live off ramen noodles? All right, maybe it's going to be good type thing. So the question then, Will, for the audience, so how do you know if you're qualified for VC? And maybe you can expand it to other types of investors as well. Break it down.
Sure. First thing I would say is you probably are not qualified. By definition, most founders are not qualified in the way they think. Like, it used to be like, well, I guess I got my MBA and I guess I've got like this. Most founders that wind up doing the best have the worst qualifications of all time, right? Like, if you look at, famous founders like Brian Chesky from Airbnb has been all over the news lately, with his founder-led companies. But we did an interview with Brian when he was first starting, and in his story, it's hilarious, right? Like how unqualified he was. Coming out of Rhode Island School of Design, RISD. And he said, for a long time, I lived in my parents' basement, right? This is the CEO of one of the most like promising, biggest outcome companies there is. And he's one of a gazillion. Here's what I'm going to say. There isn't some certification you get that makes you qualified. What makes you qualified is the deal that you're doing, is the market size you're going after. He was trying to upend the hotel industry. Yeah. That's what made him qualified, not who he was.
And they had made significant progress, not necessarily Airbnb the way that it was when they got their initial checks, but they showed enough of those qualities that I remember listening to their initial investors. It was Jessica Livingston and Paul Graham, Y Combinator. And Jessica Livingston was like, I didn't get it. I had no idea what they were doing, but we really like them, right? And so that goes back to what you're talking about. It's like, no, it doesn't tick the boxes MBA. And that's what happened. Let me share my story. This is a good one, right? So I'm in China and we got seed investment. They had to move us over there and I had to go be the CEO. So that was part of the package. So I'm in China. They would not present me anywhere publicly because in the beginning, because I didn't have a PhD. There were a lot of PhDs, you know, doing the speaking circuit or whatever.
Sure.
But then these other PhDs that took me on, there were 3 doctors, and they took me on. These are like cognitive scientists and, you know, people like really, really smart people, right? Teaching at the top universities. They took me out. I remember this to this day. They took me out for hot pot and they said, we have a question for you. We are smarter than you. And I was like, that's a statement, not a question. Right? Okay. And
great opener.
They said, but we want to know, why is it that you're making more money than all of us? And I told them straight out. I said, I am a business person. I am first and foremost a founder, and I am not strapped down by all the academia and all the, credentials and stuff that you think you need to go out and make money. I'm just going to sell a solution. And by then, like, I was in the boardrooms of Alibaba and, like Tencent and all these places, and they were just watching this happen. And I was obnoxious enough, but I didn't need those qualifications the way, to your point, that everybody else thought that they need.
Right, exactly. And I think founders get hung up because they believe there's some other echelon of qualifications that they don't have. And if they had those, again, the MBA or whatever, they could get that. But this isn't like a big corporation trying to hire you by your resume. This is someone, a cowboy, right? Being the investor, saying, I'm going to make weird ass bets on companies that have the longest shots possible.
Yes.
And the weird people behind them. I technically don't think that any founder is qualified. I think your business idea is either qualified, and that has a whole other set of credentials. And the good thing is you don't have to worry about it.
And here's some advice for everyone. If you're wondering if you're qualified for a certain type of investor, they are usually upfront about it. Like, they will tell you, we need to see this amount of revenue.
Whether you like it or not.
Exactly. Like, just go do the research, and then you will know if you're qualified or not. But I like, Will, where this conversation went. We're encouraging founders, don't worry about your personal qualifications. Hey, roll with it. Do the deal. Build a great startup, and you will see your qualifications go before you. Let's answer something from the audience here. It says, okay, question. I'm about to spend the next 6 weeks creating our app demo in Figma. Will a working fake demo help me pitching to investors, or should I wait until funded and get smart people to make it for real, which is going to happen regardless? Will, what do you think?
I think demos work just as well. Now, it depends on the product, okay? Like, if all we're doing is creating an app that mimics what the product will do, and again, all we need to do is visualize the product. I think Figma, or call it fake app, demo app, if we're going to call it that, is fine. Actually, it's wonderful. Now, if it's the case that our product actually has to do the thing. In other words, Ed, if you and I were creating ChatGPT and the fake version is actually not what we want to be showing, we have to show that the algorithm actually does, it has that level of capability. Sure. However, don't sleep on the fake demo, okay? I'm going to tell a story about where I used fake demo to raise millions of dollars overnight and why it worked. But again, why I was all for it, and we did it intentionally. So rewind back, I'm starting a company that doesn't exist anymore called Unsubscribe.com. And Unsubscribe.com was one of the first companies to help get you off your junk email before Google spam filters existed, before like anything, right? And I tap a friend of mine, again, in Santa Monica at the time, a guy named Jamie Siminoff. Some of you guys know Jamie because he's the founder of Ring, the doorbell company. And so this is, long before Ring. And I presented the idea to Jamie, and he's like, I love it. I was like, hey, you want to co-found it together? He said, sure. So we co-founded it. We bought the domain together, and we launched unsubscribe.com. Well, when Jamie and I were talking about it, he was like, hey, man, I get the idea that we'll build this app that can get you off all this email. He's like, but that's going to take like a couple of years. Like, that is a massive amount of business intelligence to parse every email and figure everything out. And I'm like, buddy, we're not going to do any of that. Here's what we're going to do. We're going to build a button, and this is going to take maybe 4 weeks. We're going to build a button that goes into Gmail, goes into Outlook, whatever the email clients were at the time. And I said, when Ed presses that button, when he presses the unsubscribe button, all we're going to do is forward his email to an inbox. And then we're going to hire a bunch of interns from USC and have them find the unsubscribe link and click unsubscribe. Now, here's where it got really interesting. And I think this video is still somewhere out on the internet. I haven't looked for it a long time. There's this video of this being tested in real time. So a bunch of internet pundits, it's almost like before podcasting, it's like mid 2000s, we're doing a tech review of new cool sites. And I think the guy was Leo Laporte, I think. I might be getting this wrong. Anyway, they're doing a live review of our app. And he's like, guys, you're not going to believe this. These guys have figured out a way to instantly unsubscribe. He's like, watch what happens right now. And he goes on and he hits his unsubscribe button, like in his Gmail. And we watched the email come in. And the guy's name was August, one of the interns. August is like, unsubscribe. Email goes back to him. You've been unsubscribed. Like, this is amazing. This is the most incredible technology. I mean, it was so hilarious that this was like actually happening in public. But as soon as we did that, as soon as that episode aired, I think TechCrunch picked it up and like a few other places. And we got inundated with VC interest. We raised a couple $1 million on a seed round before we even had a chance to put a deck together.
Just shows you the power of MVPs, right? Let's get even more granular. Let's take it down just right to the studs. Because Dropbox, they raised money on a video. That's it. It was a video demo, so you can do that. And I know Figma is very alluring as a tool. But I got a question for you, Will. Let me explain and set this up. Because one of my companies, I bootstrapped, and I didn't even develop the interface. I just did via Photoshop and Illustrator a concept of the output. So I got data from them using an Excel spreadsheet, and I did it manually. And then I asked them, I said, how much would you pay for this information? I got this black box. It's amazing. And they said $3,000. I said, done, sold. I stayed up night after night with Photoshop and Illustrator and basically created the outputs and made it look like I had the whole system developed. And I bootstrapped $145,000. And then I used that then to basically fund my development. That's pretty much what I did. And so you can get a lot done for very little. And I know, and this is my question to you, Will, because I see founders do it all the time. They torture their Figmas. They torture their demos to death. When do you stop? How do you know?
Here's what I'm saying. All we need to do with the Figma is visualize the concept, not the detail, right? Let me put it this way. Ed, if back in the day I had invented the first car and I was like, everyone's riding around on horses right now. I've invented the first self-propelled car. And I roll up in my car to your cabin, right? And I'm like, bro, look at this thing, right? The last thing on your mind is like, oh my God, I don't like the style of the fenders, or does this have heated seats, or what kind of radio does it have? You're like, holy shit, this thing, I don't have to ride a horse. In other words, like the core functionality, what it was intended to do,
exactly
tells it. It doesn't need to be blown out. It doesn't need to have all these features. It doesn't need to have all these things. It needs to just demonstrate the core value prop.
And on top of which, when you start to demo it and show people, they're going to let you know what they want to see. Like back to my whole thing that I bootstrapped. I got feedback from my initial users, and they were telling me, Ed, we can't use this and sell it upstream to accounting, to the C-suite. And I said, okay, what's the problem? And then I said, what do you want to see? And they said a dashboard. I wasn't even thinking about a dashboard.
Sure.
So they gave me the feedback. So if you start showing your minimalist demo, they're going to ask you questions like, where's this button? Where's that? And then you'll know what else to put in there.
Agreed. I never want to build anything until I've built something and showed it to people, because I've been doing this for over 30 years. And I can tell you, I've never gotten it right on the first attempt, not even remotely close. I don't even try, right? My first attempt for a product, I'm like, here's a bunch of raw clay, mark it, tell me what it's supposed to be. And I get the feedback and I shape it into what it's supposed to be.
And that's what I'm worried about this question, saying I'm going to spend the next 6 weeks. I really hope and encourage the founder here, break it down, segment it. Say, I'm going to do it for a week, and then I'm going to show someone, and then I'm going to do it.
Sure.
So you've allocated 6 weeks of your time, but segment it, because the last thing you want is to spend 6 weeks, show something to somebody, and nobody cares.
Yeah, right. So there is some level of investment. It might be a week, it might be 3 weeks, might be 6 weeks, right? Who knows? But the idea is, to your point, get it in front of folks as fast as possible, because let the market shape your idea. Our job is to start it, the raw clay. The market's job is to make it into what it was supposed to be.
Next question. Is my idea worth starting? How do I know? This is a big one, happens all the time. And let me just set this up for you, Will. We have founders that come and they're already way sold out on their idea. They've YOLO'd in 150K of their retirement funds or what they were all saving, and nobody cares. And they come and they're desperate. And so this question, is my idea even worth starting? Is it worthy of a startup? How do I know? What would you say to those founders?
I always say I want to segment this into 2 questions. Is it worth me starting anything? And then what's the value of this idea? Okay, so bear with me, because a lot of times we connect them together.
Sure.
It's not worth me starting something unless the idea is good. Here's what I'm going to tell you. You'll lose every time on that. You'll lose every time. There's almost 0% chance that when you first have an idea, it's the perfect version of an idea.
Exactly.
It almost can't be, because no one's seen it yet, right? You haven't play tested it yet. So now, like when I build businesses or build products, etc., I don't try to build, quote, the right idea. Instead, what I do is I say, let me get the ball rolling toward the right idea, okay? The ball rolling toward the right idea would mean like I'm putting up a quick mock-up. and I just want to see how people use it. I'm adding a couple features and I want to see if people use it. I'm telling people about it. I'm not even building anything. I'm telling people about it and I want to see how they respond. I've learned after so many attempts that you can't build the right product out of the gates, but you can build toward the right product. So when I'm bifurcating that question, the first thing is, if you're ready to start something, go start something. But don't start it because you think you have exactly the right idea. Start it because you want to get toward the right idea and you're willing to start this discovery.
That's a great process, taking that first step, because Will, you and I both know what ends up happening is, sure, you can get something started, but you've probably iterated so many times. And then even so, let's say you do get something started, it might not become a startup. It might not be something that you want to spend the next 10 years, raise VC, like totally mortgage your life into. You might end up at the end of it going, not really.
Everything I've ever started that was successful started as something totally unintentional. And it took me a while to get it. Now I work with thousands of startups and I just see that it happens everywhere. So I understand why that's the way. But when I was first starting out, I didn't have any context. I just assumed the way an idea works is you have a genius idea. It's so good that when you introduce it to the market, they just eat it up and it takes off. And bad ideas, that doesn't happen. Bad ideas just die and good ideas just take off instantly. That happens never. It's never. That is not the way good ideas work. You know, let me go back. In a previous question, we were talking about my old co-founder, Jamie Siminoff from Ring, right? Before Jamie started Ring, the doorbell company, I remember sitting with him in my basement. He was in town. He was staying over, right? And he was showing me an earlier version of it. It was called Doorbot at the time. Okay. And I remember being like, dude, this is the dumbest idea I've ever heard. and to be fair, it was. At the time, it was. And Jamie's a smart guy. Like, I think he agreed. Here was the idea. The idea is that when someone rings the doorbell, you'll get a text message on your phone because you can't hear the doorbell. And I'm like, how many people aren't hearing their doorbell or responding? Like, how much foot traffic are people getting that they need this constant hotline of who's at the door? I'm like, that doesn't make any sense, right? But let's stick with that, okay? Jamie knew enough. That was like his sixth business, right? Jamie knew enough that it didn't have to be this idea. It had to be the path toward an idea, of which this was a step. When I started Startups.com, incidentally around the same time, at that point, I'd given up on finding the right idea. I'd given up. I'd be like, you know what? Right ideas don't exist. What I'm going to do is I'm going to start with a premise. My premise is that founders need a ton of help and they don't know where to get it. And my journey is going to be, I'm going to figure out how to help them somehow. And I had 900 ways that could have worked, and it wound up becoming Startups.com. But I think what worked for me is I said, I want to solve that problem, and I let that take me on a journey.
Let me unpack that because I think that's so key. You said something that resonated with me. It's like, if you're going to start something, just get started on something. But you also just shared, it's helpful, and I would say these days sort of imperative to start with the problem. Like, just commit to the problem. And I know founders are so obsessed. I got another story, another great founder. He's got VCs chasing him, etc. He started off, and he knows if he hears this, he's going to know, because we went through this whole process together. He started off saying, I'm going to find a better way to get people headshots and for a company for their LinkedIn. So he was doing this thing with WeWork and everything. And that evolved to people giving him feedback saying, I like the fact coming here and get pictures. I want distribution. He was like, maybe I can distribute pictures. And then he said, maybe weddings. And then it just kept going and going and going. And now he has a funded company. He's got VC backing, everything like that. To your point, looks nothing like that whatsoever. But he started off with the problem and he started moving in that direction.
You bet. So when people saying, is my idea worth starting? I'm going to tell you no. Because by definition, the way this works is whatever your idea is, it's the wrong version of the idea, and the right version is somewhere out there. You got to commit to wanting to start the process of discovery. And eventually, if things go well, you'll find the right idea. And maybe not, but there's a 0% chance you already have the right idea, and only time will tell you otherwise.
What would you say, Will, is the percentage of ideas that actually get to the final stage? Let's say, funded or making money.
Yeah.
How many iterations or how many ideas have you started up until that point?
I think for most folks, it's not that they start lots of ideas. It's they start lots of iterations of the idea.
Got it.
They have an idea that says, I think the world's going to want cheaper hamburgers. I'm talking about McDonald's, right? I think the world's going to want cheaper hamburgers, and I'm going to try 20 different ways to do it till eventually I find something people are willing to eat at a price point they're willing to pay. Right. So in my mind, starting a company isn't about the idea. It's about the process of discovery. The problem is most people have no idea that that's how it actually works. So the way they go into it's way different.
I appreciate the breakdown. That was a good one. We have a question from the audience here. When speaking to investors, how to decide, ask one of them to be the lead investor. How important is it to lock down the lead early? Is it the first one that replies? Do they tell you they want to be the lead? This whole concept of lead investors, I know, can get so confusing. So Will, break it down for us. first define lead investor.
Okay, so a lot of folks don't understand that within an investment round, you don't just have one investor. The average funding round has what, Ed, 6 investors?
Oh, I don't know what the stats are, but my funding rounds, there were no less than 3 investors for sure.
Right. It's almost never one investor.
Exactly.
Okay? Like when we say never, there's a spectrum on this. Of course, there's someone who's done it with one investor, right? So don't think that because one person has done it, that's the way it got done. The last time I checked with our friends over at Carter, which is the cap table management company, they were saying it's somewhere north of a half dozen investors in most seed rounds. That was one particular round. Anyway, what's important is to understand that there's a 90% chance when you raise money, you're going to raise it from a multitude of investors. Now, the reason you're going to do it from a multitude of investors is because it's in their best interest to spread their risk. Instead of one person putting in all the money and having all the risk for that investment, they say, hey, you know, it'd be cool. Let me invest less money. Yes, I'll take a smaller portion, but my probability of success goes up a bit because now I've got 5 other people that are sharing the risk with me, which means when the company needs more cash, which it always will, it's not just me providing it. They're going to kick in some cash too. When the company needs connections to other investors that'll participate, it's not just my Rolodex, it's everybody else's Rolodex too. Now, within that though, the big question I'm going to have per the lead investor is who's willing among all, let's say 6 of us, to do all the work?
Yeah.
Right? And how would you describe the work?
Oh man, where do we even begin with all the work? Like when you're saying due diligence, like it's all the way straight from right in the beginning, understanding, then socializing it, and then checking the founder. Have you dotted your I's, crossed your T's? Most likely, we have to go and do way more due diligence than the founder even provides. So we take the founder's numbers, we crunch them again, we go in the market, we start talking to people, we start talking to customers, we start talking about potential future investors. There's so much that goes into making that decision, especially if the checks are bigger.
You bet. And so stick with that for a second. Let's say there's 6 of us, okay? Let's say you and I are both 2 of those 6 investors, right? Here's what I'm thinking, Ed. I'm thinking, I really hope Ed does all this work because my check's going to be the same size either way. The only difference is whether or not this consumes a bunch of my time, of which all of our time is exactly the same, right? And so what I'm going to tell the startup, do you have a lead investor? And what I mean by that is one of the investors that's in this deal willing to do all of the work, the diligence, the negotiation, et cetera, for all of us? And do I trust that person? Do I trust that person to do that work? So if you're like, oh yeah, we got a lead, it's my brother. Nope, not going to work.
Exactly.
Right? I need it to be someone that I believe will be impartial and be able to look at this deal and say, this is a terrible deal. And here's the thing. There's a signal. When no one is willing to do it, there's usually a reason.
Exactly. And let's define this for a second because the second question came in. What's the incentive? Typically, the lead investor has the most influence because I find, and Will, I don't know about you, but my lead investors have typically put in the most money. So
that's usually the case.
Therefore they're going to do the most due diligence.
Right.
And there are investors that never want to be the lead investor. They're like, I just want to tag on, tell me what's going on. So I have people in my life, they say, Ed, if you ever invest in something, let me know and I'll tag on, I'll match you, I'll follow on. So typically the lead investor, that's the incentive, is they've got the most to put on the line. But they also get the most to benefit from, not just from the spoils perspective of a return on investment, but as far as being the lead investor, having the influence, having that network and saying, yeah, we threw the biggest check around. That's important.
Yep. I always think of the lead investor like the investor's team captain. It's an unofficial title, right? It doesn't have true authority, but it confers from the other investors that they believe in that person as the lead. Also, the other reason you'd want to be a lead is that you want to lead negotiating the terms. Right? If you let someone else be lead, you're kind of beholden to what terms they may have run. If you're your own lead, you get to be kind of the team captain who negotiates on everybody else's behalf, which is great. Not everybody cares.
Let's make this explicit. For example, not saying this happens all the time, but typically happen. Let's say you got 6 investors, 5 of them are smaller, and then I come in as a lead. You know what I'm going to do is I'm going to put in the most money, but I'm going to ask for the most rights. So you can get the money that you want, and there may be something called drag-on rights. And this is something that a lot of founders don't realize, in that if I decide later on I want to sell, then it forces all the other investors to sell. They don't have a choice in the matter because guess what? I'm the lead. I'm going to dictate the terms. And so there are things like super pro rata rights and all sorts of follow-on rounds, everything that goes in the contract, including, the next question came in, voting rights. You have to understand, founders out there are 2 factors when it comes to raising money: the money and the terms.
Yeah.
Typically, you're going to pick one. If you want more money, you're going to have to bend to some terms. If you want the terms, you're going to take less money. And so lead investors know this game and they understand. So that's the game that you play, and that's the reality.
Agreed.
So do you actually ask someone to be the lead investor? How do we get this dance going?
I think part of the question is simply just asking, will you be the lead investor? And in my experience, there are just an archetype of lead investors, people who want to be the alpha, so to speak, and then a lot of people who aren't. Like you mentioned, there's a lot of people that just won't lead investments, and that's fine. It could be a time thing, it could be a confidence thing, etc. And then there's other people that are like, I don't want anybody standing in my way. I'll run my own show. Frankly, I would be the lead investor because I have that alpha tendency where I'm like, I want to be in control of my own destiny, and it would terrify me to rely on someone else's diligence, etc., which is also why I'm not an investor. Why I would be terrible at it. Anyway,
it's not fun. And the advice that I would give is the potential of a lead investor will make itself apparent. You'll know because they're the ones who are putting in the work because they're going to be writing the check.
You bet.
And that you just formalize it and say, hey, you're putting in all the work. Is it okay if I call you my lead investor and make that happen?
Right, exactly.
One more follow on, and then we can jump into another thing here. If you lock in a lead early, can that scare off others that may want control?
I've never seen it happen. I think I've only seen a lead being a good thing. I'm sure there's a case where it wasn't.
I've seen it even better, that it works in your favor when someone says they're lead and someone else wants to be the lead, and then now you've got bidding wars. It's rare.
I hope you have that problem.
Yeah, exactly.
That's a high-class problem.
I was talking to an investor, and he said, when it's a hot round, like I can't write the check fast enough. And I was like, man, I don't know what startups you're talking about. They're lucky that you've got that attitude.
I agree.
Next question. Here we go. This one, Will, I think you and I will have a very spirited discussion on this, and I wrote it this way.
Spirited discussions.
Should I split equity with my co-founder 50-50?
Oh, man. Let me open by saying on Startups.com, we have an entire course on it's called Splitting Equity, and it goes deep on this topic. Here's my opinion, and I'll caveat this by saying everyone has a bias, everyone has an opinion. What I try to do when I'm giving this advice, when I'm having this opinion, is I try to not just look at my own experiences, which are generally good with co-founders, but that of all other founders as well. We talk to thousands and thousands of founders. There's over 1 million founders on the Startups.com platform, so we get to see a lot. So what I try to do, and I know, Ed, you try to do the same, is take the benefit of everybody else's experience.
Sure.
But with all that said, all that preamble, the first thing I would say is that this is the most expensive decision you're ever going to make professionally. Why did you make it so easily?
Yeah, a lot of founders do that.
You just said, I don't want to give up investors more than 10%, but you just gave some random person that you met at a startup weekend half your company just because they said they'd build an MVP over the weekend. Yep. How did that happen? Like, what is that process? What do you think?
It's crazy because I think founders don't look at equity like equity. They just look at it as participation points or something like that. So they get desperate and they say, I need a technical co-founder, and then shotgun. Like I was reading Reddit. Oh my word. Like how many times do you see stories of like I offered and I have a technical person that I met. I got them off of whatever website and I give 50% of the company. Or they're college buddies of mine. Now they're lazy and I don't know if I want them anymore, but now they have me held over a barrel. Like how many times have we seen that story, Will?
So many times. And so over my 30 plus years of starting companies, I've had a lot of co-founders. Now, and I've had generally good relationships with all of them. I've only been in one situation, maybe two, where I've ever had a co-founder that I felt was outworking me. And I work like a madman. So that's saying a lot. And it's funny, I was just talking to one of them yesterday, one of my first companies, ad agency that I started back in the 90s. And, we grew that to a large company. And I was talking to him. He and I, this is like in the 90s when we were scaling this company, would have almost like an informal competition of who would be in the office first every day. And I'm talking like 5 a.m. I'm not talking about like by 9 or 10, right? I'm talking like if the sun was up, you came in way too late, right?
Wow. Yeah.
Now, and for a decade, every waking hour, and I'm not recommending this whatsoever. What I'm trying to say is at no point in that relationship did I ever say that guy's not earning his keep.
Yes.
Now, how many relationships do I see that look like that? Almost none.
Especially in startups.
No, that's what I'm saying, right? Like I'm saying most of the folks that I see within year one, not even year two, right? In year one of the quote marriage are like, why am I doing all the work? Like this person was super useful when we didn't know how to build an MVP, but now we're trying to scale a company. They've never had a direct report. How do they own half the company? And I'm like, yes. Exactly that,
I'm going to throw something out there, Will. And I think what we're saying is, one, don't make the decision willy-nilly. This is a very important decision. And that's where founders get in trouble. How many times have we seen, I've seen totally great startups get blown apart because the founders don't end up getting along. And then one founder takes the patent, one founder takes the website, on the existing software. And nobody ends up with anything, right? And it's just that fighting. But Will, I'm going to say that I always want to give my co-founder 50-50, especially if they're in the early inception stages. If they come on as the founding team, right after I've built the MVP, everything like that, then it's not a 50-50 conversation ever. But I want to give my co-founder 50-50. Does it rarely work out that way? In all my 7 startups, it's only worked out once. And so I think that lends credence to what you're talking about, Will.
Here's what I would say. For the stuff that worked or didn't work for me, I honestly don't think it never came down to who my co-founder was. I think, fortunately, we got along well enough that the company was the problem, not us. So I'll take the win on that. However, what I always want people to understand is in the formative stages, let's call it that first 6 to 24 months, you're still dating the idea and the co-founder. You are not ready to get married. Okay, so let me give that some context. Ed, you and I started a company. You and I have known each other for a few years personally, and we decided that we're going to venture out and do this thing together. Okay, there's a whole bunch of stuff that we don't know about each other. Okay, some of it we actually just can't know. For example, let's say we're both 25 years old and we're both starting a company. You don't know that your girlfriend is about to get pregnant in 6 months.
Ooh,
right?
Yeah.
You literally don't know that.
Yeah.
And that's going to happen. And you guys are going to start a family and all bets are off. This is what I'm saying. This isn't all like, hey, the other person's just terrible. It's life happens. But except it happens every single time. Okay. Other examples. We get into this. We're 12 months into it, 18 months into it. And you're like, dude, I quit my job for this because I thought we'd have enough money coming in either through investors or through revenue so that I could keep paying my mortgage. But I've got 2 months left to live financially. I need to get out of this. Okay, cool. You own half the company. So you're saying now you can just leave and go get another job and pay your bills, which I get, but how does that help me?
Exactly.
Right. And this isn't me being selfish. I'm like, I'm going to come to work for the same amount of equity you are, except you're not going to come to work. That's a big problem, but it happens all the time.
And not only that, you might have to go hire somebody to come step in who can work all those free hours. And what are you going to give them when your cap table is jammed up with basically dead equity?
Every time I hear somebody say, I'm about to give this person equity, my first question is, what are your other top 3 choices? And I say that facetiously. The question is the point. I know there are no other choices. Okay. Mm-hmm. So play that out for a second. Imagine, and I think the parallels matter. Imagine you're doing this in your dating life, in your personal life. Okay. And you're 19 years old and your son comes to you and says, Dad, I met the person of my dreams. And you're like, this is the first person you've ever dated. And he's like, yep. Have you considered maybe dating someone else before you get married? Nope. I met him a week ago. It looks good. Everything works. It's the same concept, right? Where you're making one of the biggest life choices that you'll ever make with no selection criteria whatsoever. The CTO's qualification in almost every startup I see is that he was the only person willing to write the code.
Default. Yeah.
Right. And so that qualification earns them 50% of the company. It's bananas if you think about it in this context.
There are other things that founders can think about, and maybe you want to make some comment on the different mechanisms, vesting schedules and cliffs. Very important. Operating agreements. For example, you got a vesting schedule and a cliff. You don't get anything unless you stick around for a year, and then you're going to vest over 4 years. On top of which, operating agreement. If I bring on a co-founder and I've had a 50-50 relationship with them and I'm the CEO, I have the right to fire that co-founder. It is written down.
As an employee.
Yeah, but I also get agreements in here, and maybe I'm being Machiavellian about this, but because I've been burned so many times, I say, if I fire you as a co-founder, the board agrees, etc., you walk with 5% equity. I don't care if you vested 25%. And that makes us all really sit down and think about it. It's kind of like that whole marriage thing. It's like, let's agree on the vows. Let's agree on how serious it is, who's going to take out the garbage, where we're going to vacation. Do we have in-laws living with us? Because this is going to be possibly till death do us part, hopefully. Yep. But when you've got co-founders, we're talking about a 10-year journey to get to that almighty exit, possibly later. And so hope for the best, plan for the worst. There are ways for founders to do that. There's
a reason when investors put in money, they change all the terms in the operating agreement, because there's no version where they're like, hey, let's just see how it goes, right? I'll just give you a couple $1 million. You'll get some percentage. We'll just see how it goes. We don't really need any terms around it. It's because when we get started, when we first launch, first off, we don't have options. So the person we gave 50% of our equity to, because they're the only person that can write code, I joke about who else did you interview? No one. It was literally the only option I had. So it's not like I had 10 other options and I opted for this person to 50%. It was the only way in my mind that I was going to get that done at that time. I get that. Okay. However, we end up making these perennially bad decisions when we're most vulnerable.
Yes.
So when founders come to me, and they do quite a bit, and they say, hey, I found like a technical co-founder, which tends to come up the most. I found a technical co-founder and I'm trying to figure out what kind of equity stake to give to them. Here's what I say. We'll get to the equity stake in a minute. How much to give them? The first thing I want you to understand is there's an almost certainty that within a year, you're not going to want them there. And they're like, wait, what do you mean? Like, why wouldn't I want somebody building my product? You will, just not necessarily that person, right? Because you're going to find out they have a life situation. They're impossible to work with. You know, their expectations are bananas, whatever. You're going to find out some shit. And we need to make sure that before you pick any amount of equity, you have a way out of it. And Ed, you nailed it. It's investing. And for some of you folks that have never heard about vesting or a vesting schedule, et cetera, Google it, look it up, understand it. It basically means you don't get all the equity until you hit certain milestones. For the percentage, once again, I'm going to refer back to the Startups.com site. Go find the splitting equity course. And we go into infinite detail about how to look at what percentage to give people based on, I don't know, things like contribution that you actually make, not just random ass percentages that you give to people because it looks even on a pie chart. And we talk about things like, how much are you going to actually contribute? How much are you going to contribute compared to what I'm going to contribute over what period of time? There's a lot more to this, too much to unpack here, but trust me, this stuff has been thought out. It's probably the most valuable thing you'll ever watch or listen to because it could save you tens of millions of dollars down the road.
Well said. We don't have time to get into another canned question. I'm going to invite the audience and say, if you have any last quick bullet questions we can answer, or else I'm going to just allow Will to pontificate on some final thoughts and, you know, in terms of our discussion is concerned. By the way, thank you. Like every one of these, Will, and I think you can agree, every one of these shows, as we've been doing that, has been getting better and better, livelier with better questions. And I love the interaction, Will.
Yeah, you know, it's funny. We say this quite a bit. I'm going to say it again. This is my dream job. My dream job is to sit around with you and other founders and just bullshit about startup stuff. Like if you loved sports, I do love sports, but if you were a sports nut the way I'm a startup nut, this would be ESPN for you, right? Where you just get to sit around and talk about this stuff. Now, we deal with really hard stuff. We work with founders through some of the most complicated parts of their lives. And that's a grind, right? Like, you know, to sit on the phone with a founder and go through the hardest moments of their lives and coach them through it, it's not an easy job, right? When I say it's a dream job, I'm not saying it's an easy job. But what's interesting about it is all of these problems are so big and so consequential to founders, but they have solutions. Founders just don't know it. People come to us and say, hey, I need to raise money. I don't know how to do it. People have figured it out a million times. We've explained this a million times. There's nothing new about it. There's nothing new about most of what we present, Ed, what we talk about. The only difference is our audience just doesn't know it yet. So I think what's cool about these sessions is our audience gets to say, yeah, this is what I'm stuck on. This is what's freaking me out. We get to walk them through it.
And we are not going to address anything that doesn't come from the audience. Like all these questions have been asked to us all over the place. So we don't want to spin our wheels and waste our time trying to force information or talking about things. So the way that we want to do it, this is a good thing, a comment, and really appreciate Hess. I don't think you mind being called out. You're one of our favorite founders. We talk about you all the time. This information you teach is worth way more than what you charge for it. Will, last word to you. Why do we do this? Like, I find that founders and people who've gone through startups and individuals like yourself are some of the most generous people when it comes to advice. Why? Why does this happen?
You know, it's a subculture. The founder community is a subculture that not a lot of people understand until they get into it. And some of it's counterintuitive. Like, why would successful people just randomly drop everything they're doing to help other people that haven't gotten there yet? And here's what I think it is. This subculture, the founder subculture, shares a lot of the same attributes as the subculture that I'd put with parents, in some cases moms, as well as veterans. We've all been through the same shit.
Exactly.
And we have a tremendous amount of respect, loyalty, and support for people who are going through the same thing. I'll give you a couple examples. I've seen this in real time, and I'm sure you have too. I've seen two veterans at an airport bar sit next to each other, within 5 seconds recognize the other one's a veteran and buy him a drink.
Yes,
right?
Exactly.
Coolest thing in the world, right? I buy every veteran I see a drink. And I'm not one. I just respect what they do. The same is, I'll give you another anecdote. Two moms in a grocery store, and one of the kids is just acting insane. And the moms just look at each other. They don't say a word, but they both know, and they go about their business, right? It's this unsung, unspoken kind of kinship that we have with each other. And it's very real in the founder community.
Let me add to that. Being a founder is so hard. When people ask me, should I become a founder? My default answer is no, without even a heartbeat. I say only do it if you cannot not do it. Like you just have
that's a great way to put it.
And it's so hard and it's so traumatizing. I got the therapy bills to show for it, that when a founder comes and shares with me and I see that look in their eye, I cannot help but empathize and want to help. That's how deep this goes.
You bet. And what I think is amazing is we think it just needs to be founders that aren't busy or founders, that aren't successful. Not the case. I've seen it at every stratification. The busiest, most successful founders will drop everything and turn to help somebody else, turn out to help another founder. It's awesome.
Chemical assistance aside, as we saw in the comments, we are here for all of you. And so thank you very much, everybody who's joined us. As always, we're here every Tuesday, Wednesday, Thursday. Let me explain the lineup. Tuesdays, I got my main man, Will, here. He puts on his pitch deck doctor hat on. We talk about pitch decks. Wednesdays, we got our chief marketing officer, Ryan Rattan. We go through traction hacking and go-to-market strategies. And then Thursdays, we're always going to answer questions. And we got so much going on in the rest of the ecosystem. Thank you, everyone. Like I said, if you're watching this on the internet, do the YouTube thing, like, comment, subscribe. Appreciate the shares and the social help. Always appreciate it. That's it for us. We're going to keep getting better every single time. Will, a pleasure as always. Everyone, see you next time.
See you guys. Thank you so much.